What we have done is, and this is a chapter in our campaign called Future of Asia. We're looking at the future of Asia and trying to change that narrative globally. Looking at what's happening in terms of growth, what's happening in terms of the companies in Asia, what's happening with consumers, technology, and so forth. This report is called Corporate Asia, a Capital Paradox. So we're zooming in on the largest companies. We start worldwide and look at the 5,000 largest companies worldwide. To be in that league, you have to have revenues of more than $1.3 billion. So these are very large companies. Now, as with many things, we've seen a shift in the center of gravity. So now 43% of those companies are actually based in Asia. So that's the shift that we see. We've also seen a huge amount of investment going into these companies. Now, 1 out of every $2 in the last 10 years has been invested into those Asian companies. Now, the problem is the returns have gone down. It's a global phenomenon.
How much it's gone down?
So overall, the returns on invested capital have gone down by 3% in that 10-year time period. We look from 2005 to 7 to 2015 to 17. The returns have come down. That means that we've actually seen that the world has gone from a positive economic profit of $726 billion worldwide to negative 34. So we're now seeing value destruction on average worldwide. So now this is a global phenomenon. The part of the reason is just increasing capital intensity. You go back 10 years, you had to invest 80 cents to generate $1 of revenue. You now have to invest something like $1.1 to get $1 revenue. At the same time, margins have come down. So you can see that there's a huge reduction in economic profit. Economic profit, the way we measure it, is the amount of money returned over your cost of capital. So that's the global phenomenon. Now, if we zoom in on Asia, we see the same there. And we see quite big differences, different regions, different sectors. So, for example, energy and materials sector has globally been quite a big value destroyer in the last few years. The exception being Southeast Asia, actually. So there, Southeast Asia is different from the rest of the world. The rest of the world value destroying in energy and materials. Southeast Asia has been positive contributor. We also see that, for example, financial services, especially in Europe, has been negative. Southeast Asia has been positive. So we see these regional differences and sectoral differences. There are a couple of sectors that have been great globally. Technology is one of them, in Japan, in Korea, in China, also Southeast Asia. Consumer sectors, pharma sectors also. So we see quite big differences regionally too.
Okay. Are there Indonesian companies on the list of the biggest corporations that you are looking into closely?
Absolutely. So all the companies in Indonesia that have more than $1.3 billion in revenue would be on the list. Now, right now I can't tell you this company and that company in Indonesia and so forth. But we see some of the same trends in Indonesia as elsewhere. So some of these same sectors have been doing well. As I mentioned, Southeast Asia, energy materials has been doing well. Not as good as it used to, because remember in 2005 to 7, we were in a super cycle, very high prices globally for oil and gas, for all kinds of commodities. Those have come down a lot. So it's less, but still a very positive contributor.
Yeah. What are your suggestions based on these findings?
So, several things. I think what is important, and here we see quite big differences in which sectors has the money gone into. For example, 80% of the investments that have gone into China have been in value-destroying sector, 80. That's an enormous number. It's very different in the U.S. So I think it's important that companies are thinking about what sector am I actually, and countries, what sectors do I want to actually encourage? What companies do I want to encourage to continue investing? And invest in some of these sectors that are actually more value creating than others. The other thing that we've seen is of course, we've looked at the tail ends of companies. So the the what we call the troubled 200 and the terrific 200. So the best 200, and what we see in Asia in particular is that it's tough to stay at the top. It's tougher to stay at the top in Asia than it is in the West.
Why is that so?
I think Asia is just more dynamic. It's more competitive, more dynamic, more companies coming in. There's a lot of growth. So we just see just much more dynamism. So tougher to stay at the top. The problem is it's also tougher to get out of the bottom. So it's quite... Now, we're going to look into why, how different companies... And by the way, does the different governance of companies, does that make a difference? So, for example, if you split out, if you go to China specifically, you take out the state-owned enterprises in China, the rest, the listed companies in China actually have much higher returns on average. As an example.
Because of better corporate governance.
Different corporate governance, at least.
Yes.
Now, having said that, we see state-owned enterprises in Southeast Asia that actually do very well. So, state-owned enterprise doesn't mean that you don't, so you can do well. But we're going to look into some of these differences, because in Asia it's different, very different types of corporate governance. We have kairetsus and kaibols, we have family-owned businesses and conglomerates. Indonesia is a case in point. We have state-owned enterprises as well as listed companies. We have the whole lot, much more variety. So we're going to look at, what differences do these kinds of governance make.